Good morning. I'm Gord Long with the Financial Repression Authority. I have Michael Oliver joining us today. Mike is the founder of Momentum Structural Analysis, or was called MSA, which he started in 1992. He is also the author of the book, The New Libertarianism, Anarcho-Capitalism. Welcome, Mike.
Glad to be here, Gordon.
I've been looking forward to talking to you here for a week or so. I don't think a lot of our listeners would be familiar with your background, so I'd like you to take them through that and how you came about starting MSA. But before I do, I just need to mention to our listeners that this is something new. We haven't done a technical-oriented, technical analysis kind of approach before, but I think it's absolutely critical to a lot of the things that other subject areas we're talking about on the macro level. So with that as a way of a background, Mike, could you give us some details?
Sure. Actually, I guess a lot of people that come into the financial services industry or market and business come from business school backgrounds or economics. My background was political philosophy. I was at the University of Hawaii in 1975 and working on a PhD in political philosophy. And I viewed myself as a future academician and so forth. And that was the time, if you were around then, when gold was legalized. It was legalized the end of '74, and they started trading in the U.S. in midnight of actually January 1st, 1975. And I was, as a libertarian, I was very excited by that. In fact, historical note, gold would not have been legalized had it not been for the National Committee to Legalize Gold, which was engineered by a guy named James Blanchard in New Orleans, and he was a libertarian. And he managed to maneuver the legalization of gold through Congress with the backing of some well-known conservative libertarian-type congressmen, but with Mark Hatfield on board. And he even got some liberal Democrats to vote for it because they thought it was a good way to demonetize gold, to take it out of, to make it every day, in other words. And so they sneaked this through, and gold was legalized. And lo and behold, the futures market started. And I said, that's where I want to be, with gold. And I had a friend who joined the futures industry back then. He'd gone to Merrill Lynch, I think, and said, hey, the water's fine, come on in. And at that point in academia, we were in a depression, if you recall, 74, 75.
Oh, I do. I was very much right in the center of all of that.
Yeah, well, there were tenures not being recognized by some universities. It was really getting bad for academics. And I said, heck with that. I'm going to go into the markets. And I applied to Hutton and got by Hutton's commodity division in New York City, their headquarters for their international commodity division. Head of the department was David Johnston, who was also chairman of the COMEX, and he's no longer with us. But he was chairman from the 70s through the 80s, all during the great silver crisis. He was chairman of the COMEX, and he and Leo Malamed basically are the fathers of the modern futures industry. Leo Malamed of the Chicago Merc. Anyway, so I started my training there, and as a novice, as far as the markets go, trading and so forth, and was confronted
But it was primarily futures trading, Mike.
Oh, yeah, this is strictly futures side. Yeah, so I would go down to the COMEX floor, which is a couple blocks from Hutton at that time. COMEX used to be on Broad Street, I think it was, a couple blocks from the Wall Street, from the New York Stock Exchange. Then later it moved to the World Trade Center and so forth. But back in the old days, it was in this single building. I think it was Greek-style building with columns and everything. And it was the old days. Pit trading and no electronic. In fact, when the trades would occur, there would be a guy on the side of the pit signaling, hand signals to a young man on a raft or a scale, on a chalkboard on the side of the wall, and he'd mark down the trades and the volume, the prices. So it was all done by hand. That changed dramatically in the next few years, but I really caught the tail end of the old futures industry and the emergence of the new. So I did that as a futures broker from 75 through 92, but in the process developed my own methodology called, for lack of a better term, or actually precisely, momentum structural analysis, not momentum analysis. Everybody thinks they have a handle on what momentum means. You know, if you're a momentum trader, that means you're chasing the upside or chasing the downside. That is not what I do. I detrend price. I think price is, to some, we'll get into this in a minute, is somewhat delusional. And I look at price from the point of view of its momentum action. So I create momentum charts out of price and then analyze that first and foremost, then reference price secondarily. And I evolved into providing research only, got out of the brokerage side in 1992, and have done that since with institutional clients. Cover all four asset categories: equities, foreign exchange, commodities, and debt, all of which are traded in the futures markets or in the ETF markets nowadays. So it's a wonderful world, and I've managed to carve out a place for MSA and its unique methodology, and we're causing some ripples, I think, in what is the orthodoxy of technical analysis, which has heretofore been, well, since the 1940s when Edwards and McGee wrote their book, Techniques of Stock Analysis. That's been the orthodoxy, price charts, first and foremost. We've added, over the years, that people have added little buttons and whistles on your computer screen where you can run various little tools to adjust the price and overlay on the price and so forth. But really, the core of technical analysis has been and remains based on price chart analysis, which is kind of pathetic when you think about it, because most areas of human endeavor have evolved over the last 50, 60 years dramatically. Computers have, telecom information has, medicine has, biotech. Revolutions occur, we expect them. And yet in technical analysis, we're stuck in the 1940s with very few little adaptations. It's about time for change. Not to totally denigrate all price chart analysis, but I think it is, while it's better than fundamental analysis in some respects, a little more timely, I'm talking orthodox price analysis, there's still a lot of deficiencies and delusions that are embedded in price chart analysis, which we think we've largely overcome via momentum structural analysis.
What's the philosophical basis then for momentum structural analysis that makes it different than why you're not using price and why it isn't the classic momentum?
Well, we have to go back a bit in time, and actually sort of my book, because the book has nothing to do with markets or analysis, it has to do with philosophy, and it's about, pardon me, I'm going to get off stream and then I'm going to get back to your question because the answer is in there. In 2009, Santelli had his rant, if you recall. He said Tea Party, and he the birth of the Tea Party movement. Well, in 2014, the New York Times said, this is the libertarian moment. In other words, the libertarian movement is on the scene now and it will be here forever. And in fact, it was not true. That is the second wave of the libertarian movement that we're seeing now. And it's quite large and it's ever present. You see it everywhere. Examples of it, people that are involved in it: Ted Cruz has a libertarian background, Rand Paul, Santelli. A lot of people you know and see on TV have that background and have acquired it in a recent decade or so. In truth, it started back in the late 60s and 70s with the joining, not really joining because they were adverse to each other, but of Ayn Rand with a basic philosophy, and Dr. Murray Rothbard, who was the student of von Mises, head of the Austrian School of Economics. And with the passing of von Mises, Rothbard took Austrian economics another step forward and took it to levels that probably nobody would have anticipated. In fact, if you're not familiar with who Dr. Murray Rothbard is, and I think he died in 1993, aside from being the father of modern libertarianism, he is also the guy who was instrumental in the Cato Institute being here and the Mises Institute being here. You can Google that and find that on Google. Dr. Murray Rothbard.
We've had Doug French on for our viewers who studied under Rothbard and is associated with the von Mises Institute now.
I've got a French book at home somewhere, a French book. Anyway, I was lucky enough to be there during those years, the early 70s, late 60s, early 70s, and ran a publication called The New Banner, which was the first nationwide objectivist/libertarian periodical, which was somewhat radical because the objectivists, the Ayn Rand people, were limited government. They were ardent on that, and they viewed the libertarians as a bunch of hippies. And the hippies, is led by Rothbard, he wasn't a hippie by a long shot, had a personal antagonism with Ayn Rand. In fact, they personally were involved with each other. Rothbard was part of Ayn Rand's inner circle for a period of time, and then he was ejected. And
just to interrupt you, Mike, but I was not former chairman Alan Greenspan part of that very close little group? down in
and Leonard Peikoff and quite a few others, names we are lesser significance, but
major architects of how things unfolded, actually. But
yeah. Anyway, I was lucky to be there. There were probably a couple hundred of us at the time, and this is early 70s, who were academic types or intellectuals of various sorts, but it was a very limited group of people, and it wasn't homogenized into any one entity or group or anything like that. And I happened to know Rand. Rothbard. Interviewed him for my publication, The New Banner. In fact, that's even available on the Mises site right now, Mises.org. The interview is still there in their archives. He corresponded with me for a few years, probably in hopes that I would continue in an academic direction toward political philosophy and libertarian view. But I opted out of that, and for the reasons I already went into, and went into the markets. And anyway, so that's my background. But in the process of getting back to the markets now, what does that have to do with the markets? Well, I'm not really an economist, and while I adhere to the basic concepts of the Austrian school and am friendly with those folks and their mindset, and you got to remember the Austrians are right now the key bulwark against central banks, intellectual, academic bulwark, the chief opposition with a solid set of ideas, not just here and there, but a holistic view of the central banks, which is negative. So they're quite important. And their analysis is good, and I always agree with it, generally. They're not good on timing, and they admit it, and that's what I do. I time. It's one thing to be right, ultimately. It's better to be right in a timely way. You can be killed being right, ultimately. But there was one concept that I got out of Rand before I ever read any of Rothbard's works, and it's pre-economics, pre-politics. It's a epistemological concept. Epistemology means the theory of knowledge. Okay, now how does man know things? How does he deal with things? How does he deal with reality? Man is a conceptual being, and by concepts we mean things that are built upon percepts. In other words, they're not automatic. You have to formulate them in your mind. We form concepts of what a chair is or a blue sky. Most of our concepts, though, if you scratch them, underneath there's measurement involved. There may be gradations of measurement, like color, light differences, weights, density, and so forth. But there's always some unit of measurement that man needs to build concepts so that the concepts have validity and consistent validity over time. They're not fluid.
Yeah, one of the things that I've observed is myths usually aren't based on any kind of measurements. They're based on opinion.
That's true. And if you have an opinion based on good measurement, then maybe you got something. But otherwise, let me see the
But it says, do you have the right measurement system? But right. I didn't mean to interrupt.
So,
but I absolutely agree. Measuring something is central, and knowing what to measure. That yes. the philosophical approach of what you're going to measure is everything. And we were talking once previously, in my early days at IBM, we had a philosophy that says if we couldn't measure it, we couldn't manage it. And so we had to measure everything. But what was important in that was deciding what you were going to measure, because if you measured the wrong thing, you would always get the wrong results. And I think what I've really seen in your work is that philosophical approach allowed you to arrive at what you need to measure. And I don't think I know others have not traveled that road. And could you just take us through that?
Well, units of measurement. You can have in your mind's eye various examples, yardstick, thermometer, everyday things. And of course, you go on the list are infinite. But they're all objective and they don't change, and that's why we rely on them.
Unfortunately, Mike, we have the dollar up, and I have to argue it does change. Because we're debasing it. But therein lies a point you're making, too, I think.
This is the point of the why not price? That's the question. Why not price, okay, as your unit of measure? The dollar is a symbol of a unit of measurement. It could be $10, $1, okay. It's the same over time. $1 in 1960, you hold up a dollar bill today, it may change the Federal Reserve note as opposed to silver certificate, but it's the same, presumably the same yardstick. It doesn't change, just like a yardstick. But and this is true with any fiat currency, so we're not picking on the dollar, the euro, yen, you name it. What happens in any area of human activity, industry, and so forth, where a given unit of measurement changes subtly over time, or even dramatically over time, but isn't noticed because, for instance, if you had a yardstick and you used it today to measure, let's say you're building a foundation on your house, and it says 36 inches and you measure a certain number of units of yards. But then a year later, that same yardstick is still saying 36 inches. Didn't really measure the same 36 inches it did a year before. It's now 37. Subtle growth, but doesn't change its denomination. It's still 36. Or a thermometer, you know, you want your 98 point whatever, and it says 98 point, regardless of what temperature you might have, it still says 90. Well, it's not a very good unit of measurement. You've got to count on your unit of measurement being stable. And from that stability, then you begin to measure and form concepts about, I did it right, I did it wrong, so forth. Well, the problem with the economic world and the financial world and the market world and the corporate world and the analysis world is that we all use such measurements as profits measured in dollars. Year over year, sales at Macy's measured in dollars. Everything's measured in dollars. If you're a fundamental analyst, you're usually looking at metrics that are dollar-based, or if you're European, it'd be euro-based. But if you go to, like, you know, an M2 chart, for example, and look over time and see what that's done, you can see that that unit of measurement is by no means stable, and it never has been stable. Even in my book that I wrote actually in the early 70s and published in 2013, I deal with that subject of unit of measurement. So when I came into the industry, I had this nagging negativity about both fundamental analysis based on a plastic unit of measurement. It's so plastic, you know, the number of dollars per decade virtually doubles every 10, 12 years. And it's done that.
Mike, you know, the fundamentalists and everything would say, yeah, we understand exactly what you're saying, and that's why we look at nominal values and real values, and we adjust it for that degradation for inflation, and therefore that's a closer measurement. But then the argument is, but is the adjustment, the CPI or the inflation rate, is it being measured properly? So you get the compounding problem. So I don't think they personally ever fixed it, or they have translated it properly. It supports your point. Price is an illusion.
Yeah, and you're right. Their filters to supposedly correct that are horrible, to say the least. Now we know that, you know, this money growth that we see, the water in the swimming pool rises every decade. It doubles. Okay, and therefore, you know, if you bought a stock 10 years ago for $30 and it's trading at 30 now, you're not break even. Okay, by any sense of the word, you're not break even. And most people know you got to back fit the inflation into it or out of it and so forth. And they use these metrics that aren't very good, the CPI and so forth. And also we know that, you know, that this growth in the yardsticks, the number of yardsticks, units of measure that exist, doesn't always go uniformly everywhere. Everything doesn't rise equally. Sometimes, you know, investors have preferences and they shift their preferences. And, you know, for example, between 2010 and 2011, stocks were not the preference. Commodities were. Commodities and gold beat the pants off the stock market in terms of performance. And then in 2011, that changed. Commodities topped out relative to stocks and in net trend and went down. And at that point going forward, stocks were the beneficiary of all this liquidity. And I think that's in process of changing again right now. But nevertheless, your unit of measure that changes so dramatically, doubling every 10 years or so, has to be viewed with extreme skepticism. And you can't just take a CPI and counteract it, backfitting the inflation out. So there's other methods of methodologies of measurement that you can't get away from price ultimately, because even when I measure it and convert it to momentum, there's still price lingering in the background as helping me make the momentum charts. When I make a momentum chart, by the way, there was a technician at Merrill Lynch back in the 70s. I think he's still around, Bob Farrell, well-known orthodox technician. And he had some 10 rules of investing. I think his number one rule is markets always return to the mean. And that's a widely accepted assumption. It's overlooked often by people who are trend followers and get stuck in a bull trend that's 5-6 years old and don't realize it's time to return to the mean.
The question is, what's the time frame on the mean? That's always the issue.
I've produced for my clients charts going back 100 years on the Dow and the S&P, and starting the S&P in the 50s when it began, the Dow before that, just showing annual swings in price relative to a 3-year average or 36-month average, an annual 3-year long-term average. And there's no trending in it. It's this. It's oscillation. The market breathes constantly. Sometimes it will come down to the mean and stop, the 3-year average or a 3-quarter average or a 200-day or whatever. And quite often, on every other time, it'll go through it and oscillate on the underside of it. So markets breathe. And the failure to acknowledge that is suicide. It's great when it's trending up, and when it comes down and you count on the mean holding it and it doesn't, then you've got a big bear market. And this happens continually, almost, I would say cyclically, but I'm not a cycle guy, but I can almost make a case for a cycle. I can't pin down the time frame, but I would say thinking cyclically is a good idea because it keeps you flexible. But so what we do is we measure by means, by averages. So we don't just lay a moving average on a price chart. Anybody can do that. That doesn't help at all. And the reason it doesn't help is quite often a market will appear to use a moving average as support, like a 50-day or 100-day or 200-day. Everybody looks at those. And it'll come down and it'll hold it. And they say, oh, look, it's holding the 50-day average. But it just as often will oscillate right on through it. It'll knife it. And if you use something like a 200-day average as a routine buy-sell signal, you'll be killed. Because the number of times I've seen markets go down to their 200-day or go up through it by a marginal amount, just enough to hook everybody on the other side, and then flip and go back the other way is countless.
Well, I would suggest 50, 100, and 200-day moving averages are just bread and butter to most people in the market. They just study them, death crosses, etc. Yeah. And they make money, but then when they lose big because they go against them, and they lose their gains. Is that a fair observation?
Yeah, no, I think so. I think that, I've seen markets. In fact, that's one of the things that momentum does. It finds this repeated action by a market and can see it better than you can looking at a price chart. I think there's like 4 examples I brought today of long-term, very long-term momentum studies of the S&P in 2000 top, the 2008 top, the way crude oil looked in the summer of 2014 before it collapsed, and the way gold looked in 2011 at its top and also at its recent bottom. And on these charts, I use a 3-year moving average, which is a very long-term average. I use others too. I don't just focus super long-term. I do quarterly momentum, 3-quarter average, 3-month average, 3-week average, 10-day average. I oscillate versus a lot of means. So MSA is always focused on the different trends a market might have, because markets never have one trend. They may have one long-term trend that sustains for 3 to 5 years, upside or downside. But within that trend, there'll invariably be severe counter-trend moves, either up or down, which, if you're not cognizant of, can really hurt you. And therefore, if you're short the market and it has a bear market rally, you want to, if you think it's going to be significant enough, you want to have some warning about it. You want to step aside.
This would be something that people would say there's a short-term trend, an intermediate-term trend, long-term trend, and they're working in some sort of concert between them. So you really have to decide what kind of, not regression, but momentum, moving average that you choose to identify which trend, right? That's what I'm hearing.
It's like having the sand clocks. One of them, you flip it over and it takes 3 years for the sand to move from the top to the bottom. The other one takes 3 months and so forth. Each of them is doing their own thing. Each is valid. Each is a trend, but each has its own clock. Now, sometimes they come into sync. That's when it really gets fun. When, let's say, for example, gold broke out recently to the upside. We'll look at that chart later. It not only broke out on its annual momentum, it broke out on its quarterly momentum, virtually within $20 of where it broke out on its annual momentum. So a very tight shot group of measuring momentum breakout. That's not always the case. Sometimes, example would be the 2000 top in the S&P. When we broke down on annual momentum, and again, we'll see that. Quarterly momentum at the time was in total contradiction to annual. So when I put out a report in January and February of 2000, warning that we were at the top because annual momentum said so, I said, however, quarterly momentum is not quite in sync and it looks like it wants to go up some more. So sure enough, the market gave its major sell signal in January, had a good sell-off, in fact, after that, but then came back up in March and made a new high. So if you acted solely on the information of the annual momentum saying, this is the top year, you're here, it went beyond you maybe 5 or 6% in the month of March. So, if you're only looking at a price chart, you'd think, well, I'm wrong. It made a new high. But momentum says no. It didn't change anything. You're still dead man walking. But quarterly momentum was in an uptrend and was out of sync with annual. So, the lesser trend versus the bigger, you fit them together. But when that quarterly momentum finally ran out of gas in the summer, by October, you could tell they were both in sync. Annual and quarterly were in sync, and that's when the big bear market started in force. There were still bear market rallies on the way down. So what we try to do with momentum is, while we can't totally ignore price, because it's, after all, is part of the momentum measuring process. We're measuring price bars in relation to the 3-year average, and therefore it'd be above it or below it, depending on where it is in relation to the average. So the oscillator is created with the function of price and where the mean is, whichever mean we picked to measure by. And at least those means, they change, but they're changing because they're set by price. You can measure where they are. So the average is here. It's an objective number. For instance, this year, the 3-year average in the S&P is 1895.95. It isn't going to change all year long. And so we oscillate each monthly bar in relation to that number. And we get a visual construct of the market when we create our momentum charts that sometimes will smack you in the face due to its divergence or difference from what you see on the price chart. And so you get a totally different view of the trend reality of the market by looking through price when it's converted to momentum structure. That's what we do. That's our first place we look, and then secondarily we'll come back and look at price. Generally in the middle of a trend that's underway, a point at which everybody then realizes it's underway, even the price folks, momentum and price will get back in sync again. There'll be compatriots in the trend. They'll ebb and flow together. Where momentum plays its greatest role, and where most money is lost or made suddenly, is at the points of transition, a market top or a market bottom, where quite often we experience a whoosh effect. For instance, when we opened January, I'd announced that where you closed December 2015, in our reports, we closed at 2043 on the S&P. I said, that's okay this year, but as soon as you open next year, I'm going to blow annual momentum through a floor that's 4 years wide. You don't see it on our price chart because 2043 on the S&P was comfortably 180 or so points above what had been the August low of last year. So you look at a price chart and say, well, heck, it was 1867, I'm 2043, no problem. It was a problem pretty quick. You took out the 1867 low, and that you also took out the October 2014 low.
Mike, I need to make a point there because I was heavily involved at the beginning of the year and the end of the year and what would happen, and everybody really felt there was first quarter weakness coming big time. The smarter guys were believing it would roll to probably January options before the sell-off really began. Nobody could see it happening on the first of the year immediately, and has seldom ever done it that quickly in the first 5 to 6 day trading days in a year. Your work, and I've seen it, clearly showed that was going to occur. It would be a real anomaly if it did not occur. Mm-hmm. And so I just need to say that to listeners. I saw nobody else that was even anticipating that in any way. At least they were talking openly about it. Mm-hmm. So it proved it. It showed it. And I'd like us to, if we could, Mike, for the sake of time,